Hello and welcome to the Monday Futures Market Outlook for June 3rd, 2013. This is Patrick Sresna. As always, we start off a chart of the U.S. dollar index futures, and we had the U.S. dollar numerous times test up in the 84.75 level in the prior weeks, and we've had a substantial turn down in the U.S. dollar since then. This begs the question as to whether the trend that we've been anticipating on the upside really will be able to endure in the bigger picture. And while we still at this point have to respect that that's the primary trend, we're looking for little clues on the front of the euro and a couple other currencies like the yen as to what is in store for the most immediate trend. At this stage, the likelihood in the bigger picture of the U.S. dollar remaining upwards in trend is very much in place. But if we're right here at this 83.25 level, if we can't see the U.S. dollar gain any support along here, then we may go for a full retest of 81.50 on the downside in the upcoming months before a real short-term low in the U.S. dollar kicks in. The same regard, though, if we see that the selling is really subsided here, particularly if the euro can't really beat the 131 level on the upside, then the U.S. dollar to the upside still remains the primary objective. So next year, when we take a look at the euro, this is where a very big decision point is coming for the U.S. dollar. The euro initially has so far held that 127.50 focal point down below. Really, the 128 level has contained almost all consolidations at this stage. And the euro has tried to burst up toward 131 recently, but really has not demonstrated any follow-through. It would be above the 131 level as we head up to 132, 133 that immediately would neutralize the downwards pressure of the euro, and really we'd have to start considering that we may have to wait several more months before the euro begins any bigger picture correction. In the same regard, if we find ourselves later this week or on the jobs number on Friday with a drop below 129 on the downside and the downside window reopens, suddenly that euro down, US dollar up scenario really starts to re-engage. And so we're really at a major decision point on the currency front, and we'll find out definitely this week, particularly into the Friday jobs number, what's in store for this currency trend. Next here, I want to take a look at the 30-year Treasury bond, and we were outright bullish this Treasury from the lows back in February, March along the same 141 level, and we at this stage have not only participated all the way to the upside, but at this stage we find ourselves having fully retraced the entire bullish breakout on the upside. This is a major decision point. We still are maintaining our risk-reward proposition as good because the likelihood that there could be a full Fibonacci retracement back to, let's say, 144 or 145, 46 on the upside of the Treasury bonds is quite possible at any stage here, and so therefore downgrading it right along a major support line is not necessarily a good risk-reward proposition. In the same regard, a failed rally attempt on the upside would almost immediately have us neutralize our outlook on bonds in the bigger picture. There's a lot of media out there that is really working the fact that they believe that the Treasury bond bubble has burst and that it's going to just sell off from here. We still don't subscribe to that outlook, even though at this stage technically there's very little evidence of an uptrend being really in place here. So we remain very neutral on the Treasuries here. Next year, when we take a look at copper futures, copper remains hovering around that 335 level where we have had a focal point for the last several months. This is going to be an interesting decision point. Like if the US dollar still has one more leg lower to retest 81.50 as the euro, let's say, heads to 133, during that time we could see a copper thrust up towards 350 on the upside and then spend a period of time consolidating in between this 330 to 350 zone on the upside. In the same regard, if at any stage, if the US dollar had any robust breakout on the upside, that would almost immediately put copper at risk of another leg lower. These types of little consolidations off the lows can take many months, so it would not be out of character if we don't see a massive currency move underway in June, that copper really just chops in a 20-cent range up along these upper zones, so making a little bit higher highs and sideways consolidation. and we may not have a pending move on copper at this stage unless it's driven by a catalyst. Next here, we're going to take a look at crude oil. Crude oil remains very neutral. We've been in a sideways range for pretty much an entire year at this point, and crude oil is very definitively non-committal, as we're like literally in the dead center of the top and bottoms of these ranges. Now, we've seen in the past some extraordinary crude oil moves of $30–40 in a span of just months. We've literally to this point been void of those types of variables, but at some stage we could see something drive a really motivated move in crude oil. At this point, we have to simply remain very neutral, the commodity here, and we may see weakness gravitate all the way back down to the 87 range down below, but there's nothing stopping from this Fibonacci retracement zone around the 90–92 level, containing all the current selling in crude oil, and then crude oil over some period works its way back up to $96–98 to the top end of the range. So we remain very kind of neutral. You can try a swing trade crude oil, but there's no imminent move that's really demonstrating to be underway here. Next here, I want to take a look at gold, and gold is at a very interesting crossroad. A lot of traders could be fishing for a double bottom in gold down along those two circled zones, but really at this stage, the entire the last 2–3 weeks of consolidation in May really ended up being just like a little flagging formation that's retracing the early May drop from the 1480 level back down to 1360. And so really at this stage, if gold cannot follow through on the upside, there remains vulnerability that gold will not only retest that 1350 level, but that we could even have a thrust to a lower low on the short term. Now, what's interesting is gold stocks have truly started to show signs of trying to bottom out. There's a lot of things that we could fish around to suggest that there might be a chance that gold has bottomed, but there's simply no technical evidence that I can present here that can substantiate that case beyond just a speculation that support line will hold. So we're going to look for those major clues in the upcoming week or two. If we see gold start breaking down below 1380 on the downside, it may be an indication that still another round of selling in the bullion may still be come before we really see more meaningful bottoms later this year. Finally, I want to take a look at the S&P 500, and we once again are now in the midst of some sort of a multi-day throwback. What's interesting here is that selling of the last 2 weeks has really very much mirrored the pullbacks in February and in April, and each time in February and April when these little throwbacks occurred, the market used that as a springboard to launch a new advance on the upside. And this is going to be the interesting storyline here, because either A, we've witnessed a topping formation and the markets are about to begin a very substantial drop lower, or the markets are going to use this as a springboard to launch another assault on the upside, maybe as much as 1700 or 1720 on the upside if they were able to do that. At this stage, while we do feel a very distinct deja vu kind of a feel based on those past pullbacks, at the same time, what has worked in the past doesn't always work in the future. As more and more traders are recognize this, it creates a much greater likelihood of them being trapped on the wrong side of the move. Even if we had a short-term rally, it may only emerge as a double top retest of those highs, and in each of those scenarios could lead to a new round of selling. We at some stage here are long overdue for a market correction, one of a much more substantial magnitude, at minimum back down to like the 1595 focal point area, or even as deep as the 1530 level. level, and if it by let's say maybe even a 10-20% chance of it emerging as a crash, in which that case we could see even a drop to 1450 or 1400 on the downside during a very aggressive round of selling. But we don't want to associate a high probability of that or make anyone assume that we're definitely predicting that. At minimum, a correction for certain is something that is long overdue for this market, and one should tread the waters carefully, being too aggressive to the upside. So just to make our key intermarket observations, we remain from a risk-reward perspective good on the U.S. dollar, but we do wanted to stress the importance of the euro remaining relatively weak for that trend to be continue. If we see the euro holding above 130 and pushing 131, 132, then we might just change the risk-reward on the U.S. dollar to a much more average one until the U.S. dollar is ready to engage the trend again. Similarly on bonds, we don't at this stage we're not going to change the risk reward proposition to average from good when it's approaching such a major support line. What we're going to be watching for is when the Treasury bond bounce occurs, where does the rally go? If we see that there's no follow through to the upside, we'll very quickly change our stance on bonds as well to a far more neutral stance rather than as optimistic. So those are pending some price action this week. Particularly, we'll know the responses to the jobs numbers. As for the stock market, until we get a much more meaningful 3 to 6 week market correction that has a proper 5 to 10% pullback at minimum, we're going to remain very poor in terms of our risk reward proposition. If we see there's a good healthy market throwback and then doesn't steamroll into some very aggressive selling, we'll change our rating to on stocks back to good and look for a swing higher at some point. But there's no evidence that changing our stance today makes any sense at this point. That was your Monday Futures Market Outlook. Thank you for joining me.